Hello everyone and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to be going over the stock market. Will there be a stock market crash part 2? How high is the Nasdaq up so far, and are we about to hit all-time highs, or will we be going back to our lows back in March of 2020? We're going to be going over in this video many different topics, including the jobless claims report. We're going to be looking at unemployment for the US in April. We're going to be looking at GDP for the United States. We're going to be looking at GDP for the China economy. And then we're also going to be updating my dividend income for 2020 because we did make some recent stock purchases today that added on to this. So to get started with my videos, as I always mention, if you're interested in using M1 Finance and you enjoy watching my content, just like the two that did use my referral link to get started with M1 Finance, this link is in the description of all of my videos, so make sure to click on that link down below and we can each get $10 and that can help get you started funded for your dividend portfolio. If you use that link, I'll make sure to mention you in the video. And to give you an update on my portfolio for the day, we did have a very green day on Friday. It was up 2.11%, and we did receive our smallest dividend in the portfolio by far, which is Apple. We went up about $41.76. In total for the portfolio, since we've started, we are up about $224.73, which makes up about a 14.03% return since starting the portfolio. $218.08 have come from market gain, and $6.65 have come from earned dividends. We focus on the earned dividends because this is the dividend growth portfolio, so that's what we're focused on here. So with this recent deposit I deposited $100 into the portfolio and we purchased 20 stocks. So if you look at my funding history, we've deposited $1,800 and so far the portfolio is a little over $2,000. So we have been performing very well. Some of the biggest gainers in the portfolio are still some of the names that you guys that watch my channel have seen. We are now up 44% on Discover Financial Services, some of the big names up here. And then we are still down on 3 of these stocks. Procter & Gamble, we're back up in the green. I bought a lot of shares for Wells Fargo and Altria on this purchase that I can show you right here. So for our recent activity, we had a morning trading of 20 buys, and I won't go through them one by one, but you can just look through the list. I'll slowly scroll down if you want to see here. I believe the biggest purchase was the Southern Company, which is like the 4th or 5th largest stock holding in my portfolio. And a lot of good companies here we're getting to buy extra shares on at excellent valuation. So I'm super glad with how we're doing on the portfolio. And to jump right into this video, what we're going to do before we show any economic data, what we're going to look at is the performance of the stock market, and specifically we're going to be looking at the Nasdaq. So if I type in QQQ, which is the ETF Power Shares, QQQ for the Nasdaq for the year, or 1 year ago today, is up 19.41%. And if we go here, let's try to find December 31st. So right here, on December 31st, the Nasdaq ETF closed at $212.61. So as of right now, the Nasdaq year to date is up. Think about what I just said for a second. After all that has went through with unemployment at all times high, with jobless claims going through the roof, people losing their jobs, GDP just plummeting, the Fed creating trillion-dollar packages to try to bail us out with quantitative easing and stimulus checks, and so many other issues that is happening right now with COVID-19 that has taken place. To think that the stock market is up through all this for the Nasdaq is pretty insane just to see. Now, those of you that don't know, the Nasdaq is very tech heavy. The biggest names in the portfolio are like Apple and Google and Microsoft. But even with a lot of these tech companies that are doing much better in these scenarios than a lot of other companies are that are brick and mortar stores, it is still crazy to think that the Nasdaq is up for the year. Even with all of the good news that has happened for tech companies recently, you see companies like Twilio, for example. Twilio is a very high growth stock that I watch. I do love this company. I won't ever invest in it because it doesn't have a dividend. But look at Twilio. For the past month, Twilio is up 86.3%. Now they do things like software development for mobile phones and stuff like that, and they have a lot of huge partners with a lot of Fortune 500 companies. I won't dive too deep into them because I won't be buying them because they don't offer a dividend or anything like that. But to think that we're up on the year is absolutely crazy. And if we'll compare this to the other two, so the Nasdaq is up 19.41% for the year. If we type in SPY, which is a spider ETF, the S&P 500, for the year, 1 year ago today, we are still up even on the S&P 500. We are up 0.05%, so even about break even. So even that's still pretty crazy. If we type in the Dow, which is DIA, the ETF for the spider ETF for the Dow Jones, The Dow is the only one that is down 7.99%. And even thinking about the Dow is not even performing that bad considering all that's taking place. Now, back when the market was down, let's look at the S&P because the S&P is the one that I like to look at. I really wanted to show the Nasdaq just because how crazy it was that we're actually up. The S&P is what I like to follow because we have three indexes that we show. So there's the Dow. The Dow is very heavily reliant on industrials and a lot of older companies and stuff like that. The Dow 30 I don't think represents the market very good. QQQ or the Nasdaq is very tech heavy, and you're really only going to primarily see a lot of the big tech stocks here. It doesn't give you a full representation of the market. So with looking at the Dow when it's focused on industrials and a lot of older companies, and tech on the Nasdaq primarily focused on a lot of newer high growth companies, the S&P gives you the best of both worlds because you get a lot of those really older stable companies like Union Pacific and Coca-Cola and stuff like that, but you also get a lot of those high growth tech names like Apple and Microsoft. So this is why I like watching the S&P. The S&P is just my favorite overall. They usually have a dividend yield that's about 2%, so that's about fair with what we are about right now. But the S&P is about break even for the year, and the fact that we've been through all of this news and we're only break even for the year for the S&P is pretty crazy. So speaking of that news that has been absolutely horrible, I haven't been through the jobless claims numbers for a couple of weeks now, so let's go ahead and get started looking on that. U.S. weekly job claims total 3.169 million, bringing 7-week tally to 33.5 million jobs lost. That is absolutely crazy. Jobless claims number last week totaled 3.17 million. It's crazy to think that we never, ever would have seen in a million years, even at the worst, like I showed a couple weeks ago, the absolute worst time ever during 2008 and during the Great Recession. We literally never broke above a million in a week. And now just 2, 3, 4, 5 million is it's just a weekly thing now. We've just become used to it. It's almost like it's what we expect. It's almost like 3.17. It's like, wow, that's a good number compared to what the last couple of weeks have been. Look at this. It's on a steady downtrend. Yay, I guess. 3.17 million is still so many people. You can see this graph here. It shows all the way going back to the Great Recession in 2008. Look at that high spike there for 2008, 2009 during the Great Recession, and then look at the difference between 2008, 2009 to the 2020 recession. Oh my Lanta, that is so much worse than the Great Recession of 2009. So let's look at the jobs report for April of 2020. So talking about the 20.5 million, out of the 33.5 that has been lost, about 20.5 have come during the month of April. So April unemployment rate jumps to 14.7%. So now with almost 15% of America unemployed, this is by far the highest we have been for unemployment in a long time. So look at this chart here. It goes all the way back to about 1940. This is the historic job loss figures reported for April. This is total non-farm payrolls changed from previous months since 1939. So about since a little bit ahead of the Great Depression. So as you can see here, you see these little dips, these little budges right here, and then the absolute peak during Great Recession was right there. And look at the drop. That is so crazy to see. I never in a million years would have thought I would get to live to see days like this and to see numbers like this and to think that the stock market is going up day by day. I think it's really scary and it's really unhealthy. To see 20.5 million lost in 1 month and to see unemployment skyrocket. I believe before the recession hit, our unemployment was right around 3%, which was literally all-time records for the good side of things. Now we're literally went from the best records of all time to the worst records of all time, literally in the span of about 2 months. So it's absolutely crazy to see this type of stuff. You can go on and read some of the articles here, and you can see the unemployment compared to the last 50, 60 years or so. You can see your unemployment spiked here in the 50s, went up to about 7, 8%, little dip, kind of stayed flat. And then it had a little spike here in the 1970s, up to about 9%. In the 80s, it spiked again, up to about 10, 11%. And then we slowly went down. And during the 2008-2009 recession, during the peak unemployment rate for 2009, 2010 was right around 10%. And we are already 50% above that. And sadly, I hate to say it, but unemployment is probably going to get worse from here on out. Now, who knows when they're going to open the economy back up? And the good news is that when the economy opens back up and a lot of these smaller businesses that have furloughed their employees, released their employees, shut down their businesses, a good chunk of them will be hiring back their employees like nothing ever happened and they never skip a beat. But that said, Also, there will be a lot of businesses that will not be hiring back their employees. Like I mentioned, I gave an example a couple weeks ago when I was talking about the stock market crash and jobless claims. There's a Pizza Hut, like I said, for example, like 2 weeks into this recession and the shutdown taking place, the Pizza Hut literally had to close their doors for good because they could not afford to stay open. I have a friend of mine that works at a restaurant and they were literally doing so bad as well that they just said, you know what? I don't know if we were going to be able to make it anyway. The owner just said, all right, well, let's just go ahead and close our doors for good because I don't want to have to risk it going through this coronavirus scenario. In this paragraph right here, I wanted to point out, in all the roles of the unemployed surged to 23.1 million, a jump of 15.9 million over March as governments across the country placed stringent restrictions on what businesses could be opening. Multiple states are beginning to relax those rules, but about 60% of the economy remains under stay-at-home orders. So this is the key part here. About 60% of the economy remains under stay-at-home orders. So literally almost 2/3 of the economy is forced to stay at home right now, and they don't have a choice. So right now, the state that I live in is Oklahoma. Right now, in the area that I live in, they're not forcing any kind of shutdown. Some of the businesses are required to shut down and are not allowed to have, like restaurants, for example. They're not allowed to have anybody eat inside. There's no types of restrictions for times that you're allowed to be outside or any type of loitering. And groups are being restricted, but it's not being super enforced. It's not like those states like New York and California, for example, that are being shut down by force. The one thing that does suck about that is that with states, for example, like New York and California, California especially is by far the largest state in reliance for our economy and its GDP. The GDP at California is so much larger compared to a smaller, more rural state such as Oklahoma. The GDP and the economy growth relies so heavily on those more populated urban states than it does on these very slow growth, very low population states like Oklahoma. So let's look at the GDP for the United States. The U.S. GDP shrank 4.8% in the first quarter amid biggest contraction since the financial crisis. This was the first negative reading since the first quarter of 2014, though not as bad as the worst of the financial crisis. Economists expect the Q1 reading to decline even more when the final revisions are issued. So usually with this economic data, they release a number and then the governments come out later and revise the number after it's been said and done. They usually have to cross their T's and dot their I's and check and make sure the final number is correct, and they usually end up changing it by a little bit. But that will give you a good idea. 4.8% shrink for GDP in the first quarter. The second quarter is expected to be a lot worse and potentially even the third quarter. As you can see here, I'm pulling up a chart. It's the U.S. GDP plunges for the quarter one of 2020, minus 4.8%, and it's comparing it to 2018 all the way up to 2020. We see good growth, 2.5, 3.5, 2.9, 1.1, 3.1, 2, 2.1, 2.1, and then negative 4.8. That huge cliff, that massive drop off that we thought we would never see. So comparing this to China, China has an economy that shrank by 6.8. The United States only shrank by about 4.8. China shrank by 6.8, which is even worse than the United States. Analysts had predicted China's GDP would shrink by 6.5% in January to March quarter, the Q1, compared to a year ago. The forecast from 57 analysts polled ranges from a 28.9% contraction to a 4% expansion. The reason why I wanted to point out this last sentence here, the forecast from 57 analysts polled ranged from a 28.9% contraction to a 4% expansion. Talk about a massive range for what analysts are trying to guess, not expect, but what they're trying to guess what the economy is doing. When you have analysts guessing anywhere from a 29% contraction to a 4% expansion, they have absolutely no clue what the economy is going to do. Usually you guess numbers for GDP. It's like, oh, one bullish analyst guess that we're going to grow GDP by 7%, and one bearish might say that we might grow by 1.5 or we might break even. When you have a range here that is 30+% differences between each other, that is astronomically larger than what you would normally see in a typical economy. As you can see here, this is the China economic growth. This is the chart that depicts the year-on-year percentage change in real GDP. Once again, just like the United States chart that we saw here going back from 2018 to 2020, I'll let you take a mental picture of this chart real quick, and then let's look at China's. They had about a 5, 6, 7% flat range, and then once again, poof, just like with the United States, just absolutely fell through the floor, absolutely breaking all types of records just like the United States. So many other countries, the reason they like to use China is because China is the #2 economy behind the United States. But it is not just China and the US, there's so many other countries. Pretty much every country on earth right now is feeling effects from COVID-19. If you look at the stock market though, so we just went through all those horrible statistics. So let's go ahead and look at the last month. For the last month, the S&P is up 5%. Let's look at the QQQ. Let's look at NASDAQ. For the last month, the NASDAQ is up 10.59%. Now, first of all, for those of you that don't know, the S&P 500, the SPDR ETF, on average with dividends reinvested annually goes up about 9.8%. So that means if you invest in this ETF and reinvest your dividends and don't touch it for 100 years, more than likely your return is going to be about 9.8% or somewhere close to that. So to think that the QQQ or the NASDAQ is already up over 10% in 1 month, it's literally outperforming what it has done in the last month compared to what the S&P does year over year as its growth. All of these articles really give you a good idea. It's really an eye-opener. It just gives you an estimate of how bad things really are and maybe how long it might take us to get out of this. Now, who knows, when we open the economy back up, we might get right back to normal. It might be a whole lot worse than all of this. There's no way of knowing. We'll just have to wait and see. And this is why I wanted to bring this up, because trying to predict the market, trying to guess where the market is going based off of this GDP number, based off of this unemployment number. If you would have been trading just off of this unemployment number and just off of this GDP, jobless claims, you would have obviously been thinking that the stock market was going to be going down. You would have been wrong. You would have lost so much money if you would have been shorting the market, if you would have been buying inverses. So like for example today alone the QQQ or the NASDAQ is up 1.37%. If you would have been going short on the market for leverage with example, let's look at the SQQQ. If you would have been going short, you would have already been down 4% today in a day. And you would have missed out on that massive gains that we had today. And don't try to predict the market based off of this information that I just showed you, because trying to predict what the market is going to do, it would be better to just go out and buy lottery tickets, because that's basically what you're doing. You're not investing, you're gambling. So this is why you buy safe, efficient companies and you invest for the long term. Because when these horrible numbers are being reported, none of these numbers were being reported right here during March, the middle of March, March 17th, March 18th, when the bottom of the stock market was happening. The numbers haven't come out yet. The market doesn't trade off of what the economy is doing. It trades off of what the economy is going to do. So the market right now is predicting that in the future, we are going to come back from this better than ever. Will that happen? Who knows? We'll see. But in the meantime, the stock market is flying high. But anyways, guys, just make sure you stay safe, make sure you have an emergency fund, and let's look at the 20 stocks that I bought right here. These 20 out of the 30 that I own, I added that to my dividend income, so I spent $101.27. I deposited $100 to the portfolio, and that was $1.27 what was left over from the dividends that I received lately. And let's look at my dividend income for 2020. So this is the chart that I pull up sometimes in my videos. I'm going to be showing it more as I get further along, because I only have the last 2 months, because I've only had this portfolio about a month and a half or so. So this is what I started with. This is my annual income, this column. This is my portfolio value, and this is the amount of dividends I've received for that specific month. So right now we are obviously in May of 2020, so these numbers are still being filled out. So right now at May 1st, 2020, the 30 companies that I own, this column right here that I'm highlighting, these are what this company paid me annually. This is what they pay me in dividends. So with the deposit I made in the recent dividend raises I had, like Pepsi for example, I added that one in. These numbers right here are the new numbers. So we go from 7.25 to 7.60. So that is a 35-cent increase. We go to Southern Company from 4.94 to 5.56. That is a 62-cent increase. And you can keep going down the list. And if you add all these up, if you add the increase from these numbers up to these numbers, for those that were added, not all of these added, you see some of them have zeros there. We added our annual income up $4.85 for that $100 we deposited. And we take this number of $75.36 and we add $4.85 to it. So let's plug in that new number here. So we have 80.21 and enter. As you can see there, we have a new addition to the chart, and this is just the beginning of the month right now that I'm filming this. It is May 10th, so it is Sunday. May 10th, and the stock market will be opening back up tomorrow. So as you can see here, our annual income is going up every single month. Our portfolio value is as well. Our monthly dividend income will be going up as well. We will be plugging in those numbers later. But just to look at these numbers, it's great to see how even with small investments, only with $1,800 deposited, we have grown our portfolio by about $200 worth of gains. Our annual income is going up every single month, and I'm sure these numbers will go from 66 to 75 to 80. And I'm sure in the coming months, by the time we get to December, we'll be well into the hundreds. We'll be 100, 150, 200, 250. We'll just keep on going up as we get more deposits. And as usual, thank you guys so much for watching. I really appreciate it, those of you that watch all the way to the end. And speaking of depositing more money to our portfolio, if you want to help me out and you would like to use M1 Finance, if you like my content, you're interested in using the platform, just like adding deposits to my portfolio, giving me this $10 for using my referral link absolutely does help build my portfolio. And I will make sure to mention these two in the video when I do get my referral money, when I get their names. So make sure to use this link down below in the description. It's in the description of all of my videos, and there's other links in there as well if you're interested at joining some other brokerages like Webull and Robinhood, and also have links there for beginner credit cards as well. So thank you guys so much for watching. I love getting recommendations for video ideas. So those of you that watch my videos and would like to have a question answered, if you would like to ask me some questions about the market, about a specific stock, about a specific sector, or anything in general that involves finance, I would love to answer it and maybe even make a video about it to address the answer. So thank you guys so much for watching. I love you guys. I'll see you next time.